Hello everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. Today's update is a classic example of life is what happens while you're busy making other plans. I saw that France went up 2 goals very late in the game against Switzerland in the Euro 2020 tournament. And so I said, hey, you know what, I can do this at 6 p.m. New York time instead of 7 p.m. and maybe get a chance to get some more of my European friends on the line. And of course, Switzerland staged an epic comeback to tie the game late. And then I actually had to pause the game at the beginning of the second overtime period to get ready. So with that prelude, I'm going to jump right in here. So thanks for joining us today. First from JP, are the deflationists missing bank lending to the government and the fiscal spending side? In a word, yes. My friend Lynn Alden had a great chart showing the difference now versus 2008, where in 2008 there really was not a fiscal impulse. It was all being done on QE was being done largely with basically taking bonds off of people's books. There wasn't this fiscal side. This time there has very much been a huge fiscal impulse, and so you hand money to the government hands money to consumers. The government borrows the money in bond markets as a practical matter, basically borrowing the money from banks. Banks turn around and sell those treasuries to the Fed, who buys those bonds with printed money. And so basically, 2 steps removed, it's the Fed handing money to U.S. consumers, just being filtered through the Fed and the banks. So wash, rinse, repeat, and that's why I think we've seen a much more much stronger inflationary response, I would say, than we saw back in 2008, 2009. Second question from WMR. Gold miners market is acting like the first part of the 2013 decline, a little hawkish talk from the Fed and no bid for miners. Do you see it differently? I agree that they are, and over the last couple weeks have acted in that way. And I think that is really the consensus narrative, that this is just 2013 all over again, that we're going to get taper and things will proceed as they did, and you can't own gold and you can't own Bitcoin. I do see it differently, though. Debt to GDP was closer to 100% then, not 130% debt to GDP. Baby boomer entitlements had just barely gone free cash flow negative. They are massively free cash flow negative now, since boomers are on average 8 years older. Taper, in our view, is really not an option until you de-lever the federal balance sheet, probably back toward 80% debt to GDP. Since we've tried it and they blew up the system trying it back from 17 and 18 is when they finally got around to QE taper. We saw them get away with it for about 12 to 18 months and then had to reverse themselves. So I think the narrative is the same at this point. I do not think that the outcome is going to be the same because we are in a very different context. Tied to that, from TB, inflation expectations are fading, TLT is rising. How long before you capitulate? The TLT is rising. People are definitely noticing that. A lot fewer people, many fewer people is probably the right way to say that, many fewer people have noticed that the Fed's balance sheet's grown $400 billion in 11 weeks. Now, the Fed has said we're going to grow at least $120 billion per month. But if we run rate out that $400 billion over the last 11 weeks, what we get is $1.9 trillion at an annual rate, which is nearly 30% more than the Fed's stated target. So TLT rising with the Fed buying 30% more bonds than they said they would over the last 11 weeks is sort of an interesting non sequitur. Secondly, am I going to, how long before I capitulate? Obviously, I'll change my mind as facts change, but I think it's critical to maintain the context that I still see so few people maintaining, which is debt to GDP in the U.S. is 130%. Throughout the last several centuries, only one nation has gotten to 130% and not defaulted on their debt, typically via very high inflation for an extended period of time or a rapid hyperinflation. And that one nation is Japan, and Japan could not be more different than the U.S. in terms of its economic setup. They're a current account surplus, we're a current account deficit. They borrow internally, we borrow externally, and so it's just 180 degrees opposite of what, and also they have a massively positive net international investment position. So in a pinch, they could call up the United States and say, hey, we want our 50% of GDP in investments that we're holding in the United States. We want that money back. The United States runs a net international investment position of negative 67% of GDP. There's no one to call for the U.S. U.S. can't call someone and say, on net, we want our money back. The money isn't there. Who they call is the Fed. And they've been calling the Fed. And over the last 11 weeks, they've been calling the Fed more. So if facts change, absolutely capitulate. If the Fed came out in extremis, if the Fed could come out tomorrow and say, hey, we're going to taper our entire $8 trillion balance sheet down to zero by Labor Day, you'll get your deflation. You'll get your dollar to 150 or wherever some of the dollar Uber bulls say it'll go. And the Dow will probably be at about 1,000, maybe 500. I don't know. The Dow, not the S&P. So in extremis, you absolutely can still get deflation. It's a policy choice. With that said, that's not a world, it's going to be a very attractive world to be in. We're watching to see what happens. So let's watch, as we like to say, right? From Larry, Luke, under your black swan scenario where the U.S. government has to allow massive upwards repricing of gold, what do you think happens to the price of other metals like silver? I think they likely go up, quite possibly by quite a bit, but I don't think they rise as much as gold. I think it's important to recognize that gold sits on central bank balance sheets, and so a revaluation of gold in this scenario will effectively be gold recollateralizing central bank balance sheets. And so that's the reason they hold the gold. In extremis, it's nobody else's liability. They can recollateralize their balance sheet, reset the system, however you want to phrase it. And so I would expect that the gold to silver ratio, gold to everything else, gold to all other metals ratios, almost all of the metals ratios would likely rise pretty meaningfully in that scenario that you've laid out that we've talked about a number of times in the past. From Prof, can you please break down how banks lend to the U.S. government and how that's credit expansion, which is inflationary? They lend to the U.S. government by buying Treasury bonds. The U.S. Treasuries is a U.S. government bond, and if you're borrowing bonds from if you're buying bonds from the U.S. government, you're lending money to the U.S. government in effect. The question then is, what is that money spent on? And as we noted earlier, this cycle, that money has been spent much more on getting it into the hands of the consumer. I'm not saying it's the wrong or right thing to do. It was probably the right thing to do to avoid an economic collapse. With that said, I think it's important to recognize that of personal consumption expenditures, PCE, which is consumer spending, I've not looked at the data series in probably a month and a half, but recently U.S. government transfer payments were 35% of personal consumption expenditures, and personal consumption expenditures is 2/3 of GDP. So U.S. government hands money to consumer spends, consumer spending is a majority of GDP. So you watch the flows, you just follow the money, as they said in Watergate. If you follow the money, you can see what's happening, and ultimately in that case, we just have to watch for changes to what's happening, and that's a key thing that we're watching for going forward. And then the last thought here from Max. Max, thoughts on whether the government is currently doing enough spending to keep up velocity and keep velocity up to where it is needed to keep nominal GDP growth up. And what will be the first sign if it's not enough? I think it's a great question. I think at the moment, yes, they are. That the Fed and government currently are doing enough given the recovery in the economy. I think the key tells to watch will be, I think, the dollar, number one. I think equity volatility, number two. And then I think long-dated treasury rates, number three. And so if the dollar or volatility start to really rise or break out above key levels, then I think that's a key sign that the Fed and or government, and really Fed and government, are going to need to do more in terms of partnering, basically monetizing fiscal spending. Initially, in that scenario, I would expect long-dated treasury rates to fall as the dollar and volatility rose. But before very long, you would likely start to see treasury yields rise as the dollar fell and as volatility, as the dollar rose and as volatility rose and as stocks fell. if they continue to not do enough from that point. So obviously, to TB's point before, the combination of dollar up, vol up, rates down at the long end did occur last week with the mention of taper. We've seen some commodity prices come off. But again, I think it's critical to understand the bigger context here, which is 130% debt to GDP. We don't have the optionality that we had in 2013, 2012, 2010, etc. It's a very different playbook. And basically a bet on sustained deflation at this point is a bet on the U.S. government nominally defaulting on treasury bonds and or entitlement payments to the baby boom generation. In theory, that can happen. Politically, I ascribe a very low probability to that happening. And so it really becomes a question of path of how much pain is needed to justify the next round of fiscal, the next round of Fed action of monetizing that while trying to jawbone inflation to reasonable levels. So with that, I am going to hang it up for tonight. I'm going to go down and hit play and see how this excellent soccer game between France and Switzerland ended up. I hope all of you have a great week. For my friends here in the U.S., it's celebrating the July 4th holiday this weekend. Happy July 4th to everybody. And we will be back in a couple of weeks to catch up on one of these updates. As always, if you enjoy them, please check out FFTT-LLC.com for what we're up to and to find out more information about our tree rings product, which continues to get great feedback. And otherwise, everyone have a great night. We'll talk with everybody soon. Take care, everyone.